2 equity offerings, $3 billion raised, and a stablecoin that could change everything or nothing at all. Look, if you're short on time or simply feeling sketchy that you came across this small channel, here's what you need to know. SoFi just diluted shareholders by roughly 10% in less than 6 months, but they're building infrastructure that could make them the backbone of fintech payments. Whether that justifies the dilution, that's what we're figuring out today. Hey there. I'm DataCat, by the way, former corporate analyst who escaped the Fortune 50 grind about 5 months ago. Now I chase laser pointers and dissect financial statements. Honestly, not that different from my old job, except that my own cat now despises me for not being there working for his treats. I'm not here to claim to be an investing guru or expert, just trying to make sense of the market from a more data-driven approach. If this kind of analysis helps you, a like and subscribe would mean a lot to a small channel like mine. No courses, no paid groups, just a cat who reads too many SEC filings, occasionally staring at the void and a constant mood swing. Anyways, enough about me. Let's break down what SoFi's been up to, because the headlines don't tell the full story. A brief recap for those who are new here. Back in July, SoFi priced an underwritten public offering, about 72 million shares at $20.85. That's roughly $1.5 billion gross. Then, just 5 months later, in early December, they did it again. 54.5 million shares at $27.50. Another $1.5 billion. So in less than 6 months, SoFi raised approximately $3 billion by issuing around 126 million new shares. And if you're a shareholder, you might be feeling a bit like a cat who just watched someone else eat from your bowl. The stated reason for both offerings? General corporate purposes. Which, is corporate speak for we have plans, but we're not telling you exactly what yet. Now here's what makes this interesting. Last week, on December 18th, SoFi announced SoFi USD, a fully reserved, one-to-one backed stablecoin issued by SoFi Bank on a public blockchain. And suddenly, those general corporate purposes start looking a lot more specific. So what exactly is SoFi USD and why should you care? First, this isn't some speculative crypto play. SoFi is positioning this as infrastructure, settlement rails, white label solutions for other banks and fintechs, enterprise-grade payment systems. The reserves, held as cash at their federal bank account. Immediate redemption, fully reserved. Now here's something most retail investors might miss about stablecoins and bank balance sheets. Every dollar of SoFi USD means roughly $1 of cash reserves on SoFi Bank's balance sheet as an asset, with a matching stablecoin liability. Even with minimal risk weighting, as total assets expand, leverage-based capital ratios matter. Regulatory buffers matter, which means if you want to scale a stablecoin operation quickly, you need capital. Lots of it. And suddenly those $3 billion in equity raises start making sense. I'm not saying the offerings were explicitly to fund the stablecoin. SoFi hasn't stated that. But the stablecoin strategy is entirely consistent with management's stated goal of increasing capital position and optionality for growth. It's like a cat knocking things off the counter. There's a plan there. You just can't always see it immediately. Okay, let's talk numbers. Yes, bear with me with the simple boring maths for a second, I assure you, it's important. The December issuance alone, 54.5 million shares, against SoFi's Q3 diluted weighted average of about 1.29 billion shares, represents roughly a 4.2% increase. If net income stayed flat, that's about a 4.1% hit to their EPS. Combined with July, we're looking at somewhere between 8 and 12% dilution to EPS depending on your baseline assumptions. That's not nothing, but here's what matters. Dilution is only bad long term if the company can't deploy that capital at returns above its cost of equity. Let me give you a simple framework. If share count rises roughly 10%, then net income needs to rise roughly 10% to keep EPS neutral. So the question becomes, can SoFi generate enough incremental earnings from $3 billion to offset the dilution? And this is where it gets genuinely interesting from an analytical perspective. SoFi USD has 3 potential revenue streams. First, net interest spread. If reserves are cash at the Fed, SoFi earns the overnight rate on that cash. They've mentioned sharing attractive incentives with partners and holders, so they keep some spread. The key uncertainty, how much of that reserve yield is retained versus paid out. Second, platform and API fees. The infrastructure provider and white label positioning suggests B2B fee revenue, likely higher margin than pure spread. This integrates with Galileo, their fintech infrastructure arm, which already powers accounts for major players. Third, indirect uplift. More payments volume can lift interchange revenue, account growth, and retention. Harder to isolate, but it compounds. Now let me be honest with you, against a diluted share base north of 1.3 billion shares, even $100 million in after-tax stablecoin profit only translates to about 6 or 7 cents in EPS. For stablecoin to be a major earnings driver, SoFi needs either massive scale, meaningful fee revenue, or both. But right now, SoFi says SoFi USD is available for internal settlement activity with broader member availability in the coming months. That reads as not immediately material to the next quarter or maybe two. Okay, so I've been a bit skeptical. Let me give you the bull case, because it's actually pretty compelling. First, they issued equity at a massive premium to tangible book value. Tangible book was $5.97 per share at Q3. They issued at $20.85 in July, then $27.50 in December. In bank math, issuing above tangible book is book value accretive. It actually strengthens the balance sheet. Second, regulated crypto and stablecoin programs tend to favor overcapitalization early. Regulators want to see buffers. SoFi is building those buffers now before they need them. Third, and this is the part that excites me as a former analyst, if stablecoin infrastructure becomes a meaningful B2B product line, if it drives Galileo volume and take rate improvement, if SoFi sustains strong fee-based revenue growth, then this dilution could look like genius in hindsight. It's a bit like when a cat stares at an empty corner for 20 minutes. Either they're seeing something you can't, or they're just weird. With SoFi, you can make that decision yourself. Now, let me quickly walk you through where the stock actually sits, because price action tells a story too. As of December 22nd, SoFi closed at $27.35. That's about 32% above the 200-day moving average at $20.77. So the long-term trend is still constructive, but it's sitting just below the 50-day SMA at 28.16, which is acting as overhead resistance. The stock is basically pinned right at the December offering price of $27.50. And that's not a coincidence. Stocks often consolidate near large primary offering prices because new holders have a reference point, there's hedging and positioning around that level, and the market needs time to digest the added supply. Now, for the momentum indicators, RSI sits at about 49, which is dead neutral for now. No momentum edge in either direction. The stock is essentially waiting for a catalyst. On the other hand, MFI is sitting at around 29.6. Remember, MFI is similar to RSI, but it incorporates volume, so it's measuring buying and selling pressure, weighted by how much actual money is moving. Normally, MFI below 30 might sound bullish, but context matters. When MFI is this low while price is still elevated, it often means buyers aren't stepping in with conviction. Distribution is happening quietly. And that brings us to the OBV and recent relatively low volume, which also shows institutional money has been more distribution than accumulation recently. So, any upside breakout would look much more trustworthy if it comes with OBV turning positive and MFI recovering above 50. On Tuesday, we were trading at a narrow range compared with the last 7 sessions, which means the volatility is compressed. Support is being contested, not collapsing. That's not a screaming bullish reversal, but it's not capitulation either. What I'm watching is that the 14-day ATR is about $1.24, roughly 4.5% of the stock price. So a move to 26.10 or 28.60 wouldn't be extraordinary. That's just one ATR in either direction. And key levels, 27 is immediate support. If that fails, watch 26.40, then 26, then 25.60. On the upside, reclaiming 28 to 28.60 would signal the intermediate trend is resuming. Above that, you've got resistance at 29.80, then the 30 to 30.40 zone, and the 52-week high around 32.50. So where does this leave us? For me, the investment thesis on SoFi right now comes down to execution. The dilution is real, the stablecoin opportunity is real. Whether one justifies the other depends entirely on what happens over the next few quarters. Specifically, I'm watching for any further disclosed SoFi USD traction, circulating supply, institutional partners, fee structures, and whether it's flowing through Galileo volumes. I want to see capital language that clarifies whether stablecoin scale will drive further balance sheet growth and potentially more raises. And technically, I want to see on-balance volume turning positive and MFI recovering above 50 before trusting any upside breakout. The bear case is straightforward. 2 dilutive offerings in 6 months, stablecoin economics that are unproven, and a stock that's struggling to break overhead resistance. Meanwhile, The bull case is equally clear. A fintech with a bank charter, building regulated crypto infrastructure at scale with $3 billion in fresh capital to deploy. Look, I've personally witnessed executives make capital allocation decisions. Some were brilliant, some were less so. The difference usually came down to whether management actually had a plan or was just raising money because they could. With SoFi, I genuinely think there's a plan. Whether it works, that's the $3 billion question. If you found this useful, consider subscribing. I'm just a cat who knows a bit of coding and analysis, trying to make sense of markets, and every subscriber helps this channel grow. No courses, no premium groups, just analysis. And remember, in investing, as in life, sometimes you have to knock a few things off the counter before you figure out what you're actually chasing. Alright, DataCat out, and I'll see you in the next one.